Hello and welcome. My name is Chris Lang, Global Placement Leader for US and Canada, and thank you for joining us today to discuss the transitioning commercial insurance market. Our goal is to provide some additional context around the aspects of the market, including rising premiums, constrained capacity, and tightening terms and conditions. Over the next hour, we aim to provide some insight into why the market is hardening, what you can expect at your next renewal, and how best to optimize your results. Please note that the audience can submit questions at any time by hitting the Q&A button at the bottom of your screen. The program will start with some comments from Martin South, President of Marsh's US and Canada Division. We will then follow with a presentation by Kyle Labar, analyst at Dowling & Partners, a leading financial analyst firm in the property and casualty industry. And then we will then follow with a panel discussion, including Kyle and various Marsh leaders whom I will introduce after Kyle's comments. So with that, I'd like to hand it over to Martin South, President of Marsh's US Canada Division.
Chris, thank you very much indeed for the introduction, and a very warm welcome to all of our clients who are joining us today. I realize that the last few months and nearly a year for many of you has been very tough. Not only have we had to pivot, learn to work from home, learn how to use Zoom, WebEx, and all the other tools, but also the whole spectre and landscape of risk has fundamentally changed in the last period of time. And the market, just to add more pain into the fire, has really changed, and certainly even in the last quarter was the most the highest increase in rates we've seen in a very long time. So we felt it was very important that we provided some context to you, to give a forum for you to raise concerns and to talk to our experts in the panel, and learn about what's been happening in the marketplace. Just to zoom out for a minute before we started, we've been keeping a global rate index now going back to the first quarter of 2012. We have data obviously before that, but this is very granular data, real rate changes going back to 2012. And what's interesting is from 2012 down to here, the market started to turn back in Q2 of 2017, and in North America in Q3 of 2018. Now, obviously some lines have changed differently, but if you have a composite index of 1 going back to Q1 of 2012, we are now, for the first time, we're just north of that across all lines of business globally. And so that's interesting that whilst it feels like it's been very tough, and particularly casualty lines, property and D&O over the last year, in some ways we're just getting back to rates that were the rates that existed back in 2012. So that just sort of sets the scene as to where we've been. The presentation from VJ Dowling, who is their hallmark is that all insurance all of the time. They really have studied in detail all of the composite insurance companies' returns and filings, so they can see what's been happening in the accident year results. And they've produced a really good analysis for everybody that we think will help you with your dialogues with key stakeholders internally. Now, this isn't to mean that we aren't advocating fiercely on your behalf to get the best outcomes. And we will continue to do that, and we'll continue to innovate and provide new solutions. And we think we're doing a decent job leading the way in emerging pandemic risks. But we realize that a lot of the pain that you all have as individuals relates to late information being provided to you, late terms being released, a lack of clarity about what's driving this. And so we wanted to provide as much context as possible for you, in order to tee up a discussion at the end with a panel. So without further ado, I'm going to pass back to Chris Lang. Thank you again for everything. I hope that you're staying safe. Thank you for your business. And with that, I'll pass back to Chris. So, Chris.
Thank you, Martin. Very appreciated. I'm very pleased at this point to introduce Kyle Labar, who I had indicated at the outset of the program is an analyst with Dowling and Partners. Kyle brings a great sense of objectivity to what's driving, the industry overall in these current economic time periods. And I think you'll find his presentation to be interesting. He will be joining us for the panel discussion afterwards. So if there's any questions or details that you wish to explore, he'll be available. Kyle, over to you.
Great. Thanks very much, Chris, and thanks everybody for joining us today. I appreciate having the opportunity to spend a few minutes giving our views on the state of the property casualty market for you. As Chris mentioned, I'm an equity research analyst at Dowling and Partners, and as Martin said earlier, we like to say that we're all insurance all the time. I'm part of a 13-person research team that focuses exclusively on the property casualty insurance market, and we also write the IBNR Weekly, which is a weekly insurance newsletter that much of the industry reads, as well as a number of institutional investors. So I'll come at our discussion today perhaps with a slightly different angle. As an equity research analyst, our job is to analyze the publicly traded insurers and reinsurers and help institutional investors make investment decisions about the various companies. So we may come at things slightly different than somebody at Marsh might, but hopefully the perspective is interesting nonetheless. Next slide, please. So let's just set the stage here and look at how the property and casualty insurance industry makes money. In practice, it's pretty tough. In theory, it should be pretty simple. You see the formula on the screen here is not all that complicated, right? It's the underwriting ROE contribution is really a function of underwriting margin or combined ratio times underwriting leverage. In this case, we're using earned premium over shareholders' equity. So the higher the leverage, the higher the underwriting return, provided that the combined ratio is below 100. Obviously, it flip-flops when you have a high leverage and combined ratio above 100. Of course, also business mix is a major consideration as the rating agencies, or we like to call them the de facto regulators, have a major influence on how much and what buckets insurers are allowed to assume risk. Next on the list in the formula is the investment ROE. So similarly, a function of the investment yield times the investment leverage. And then we have what we call this all other bucket, which is sort of a catch-all that includes all non-PC related items. So that could be things like interest expense, fee income, life insurance, mortgage insurance, whatever it might be. You then adjust for tax and you're left with the after-tax ROE. So like I said, really simple business in theory, but as we'll see in this talk, really difficult to execute on well. Next slide, please. So we just looked at what we call the DuPont analysis to get sort of a high-level view of how companies generate returns. But let's look a little closer at a couple of the key variables here. So two of those variables have been declining for at least 40 years now. The chart on the left here looks at the investment yield. So there's two lines. One is the Treasury yield, and one is the average pre-tax investment yield for the overall U.S. insurance industry. So that's what we call the embedded yield. And back in the mid 80s, so close to 40 years ago, the embedded portfolio yield was around 8%. Today, it's less than half of that and continuing to go lower, as evidenced by the Treasury and what we call the new money rate. So there's been continued pressure on investment returns. That's likely to continue going forward. On the right side, you can see the underwriting leverage has similarly declined since the 1980s. And as we mentioned earlier, that's really being driven by the rating agencies that are requiring insurance companies to hold more capital to protect policyholders. And so your leverage to underwriting results is obviously lower than what it was back in the 80s, back in the 90s, back in the early 2000s even. So with investment returns under significant pressure and underwriting leverage down meaningfully, the industry has really, in our view, one lever that they can truly pull to improve the operating results, and that's the combined ratio. And we'll look at that in more detail in a couple of slides. But first, I'd like to try to give a little bit of historic perspective. Next slide, please. So what you see here is since 1990, we've only had 3 years in which the US industry has generated an ROE north of 10%. So clearly, natural catastrophes and other large losses have had an impact on those results. There's a couple of prime examples there. 1992, the industry reported a slight loss for the year, and that was really driven by losses related to Hurricane Andrew. And then in 2001, obviously there was the World Trade Center disaster that drove a lot of the loss for the industry as well. So, a couple of years they've lost money, but you can see here that generally the results have not been great. And again, overall industry, so it includes mutual companies and publicly traded companies. The publicly traded companies generally will do better, but as a whole, the industry results are not all that exciting from an investor perspective. And the other thing I would note here is that the 2 most recent years that the industry generated double-digit returns, so 2006 and 2007, were both years of really low cat loss activity. So certainly the industry benefited from that. So all said, 2020 is going to represent, in our view, the 13th straight year that the industry fails to generate a double-digit ROE. We're currently estimating in our industry models that the overall industry will have about a 5% ROE in 2020. Now, obviously, that's also impacted by above average cat losses, as well as losses related to COVID-19. And both of those are topics that we'll address in just a few minutes. Next slide, please. So I think this is really the meat of the discussion in terms of where we're standing currently. So if we look at sort of the dynamics today, the point of this matrix is really to show that showing various after-tax returns at different combined ratios and new money investment rates. You can see on the right side there's a number of technical assumptions that we're making based on sort of overall industry averages and the like. But I'd like to focus you on a couple of things here. One is the sort of where we are today. So those are the red columns in the matrix, and then where we need to be in order to generate adequate returns for the industry. And those are the green numbers. So if we start off, what constitutes an adequate return in the property casualty insurance industry? We've long thought that for most insurers, it's 700 basis points above the risk-free rate. That takes into account the risk and volatility being assumed by companies. Now, there are some, think about the property cat reinsurers where they have significantly higher volatility. In those cases, maybe you need a greater return. But we'd say for the industry as a whole, 700 basis points over the risk-free rate is an adequate return. And so in today's interest rate environment, that suggests that the industry needs somewhere in the range of a 7 to 8% ROE to generate that kind of return. And that means that business that's being put on the books today, and that's an important distinction. It's saying new business being written today or renewal business being written today, where you're taking the premium and investing it at prevailing market rates. So we're highlighting 2% here. Maybe it's 1.5%, maybe it's 2.5%, maybe you can get 3%, but you're not able to get 5 or 6% investment returns. So making the assumption that you're able to get 2% on new money today, the industry needs to generate a combined ratio in the mid 90s in the aggregate to get to that sort of 7 to 8% ROE. And we're really nowhere near that level. As a firm, we're estimating that the industry will generate about 100% combined ratio in 2020. And as I said before, I think that translates into about a mid single digit ROE for the overall industry. So that's a sort of a snapshot in time where we stand as of right now. As Martin and Chris mentioned earlier, I think rightly there's been a lot of focus on the significant rate increases that we're seeing across the industry, reductions in capacity, tightening terms and conditions, and many in this audience have likely been experiencing a combination or all three of those trends. I'll use the next part of this discussion to sort of lay out some of the considerations that we think are contributing to that, and it's helpful to think about that in terms of the overall financials of the business. Next slide, please. So first, as you can see here, that cat losses, catastrophe losses, and attritional loss activity over the last several years, just as well as more frequent discussion on climate change generally, has really increased the recognition that the underlying exposure is greater than what the industry thought. Whether that's global warming or not, property coverages are currently hurting from both higher levels of cat losses as well as simply higher levels of attritional losses broadly. And much of that's hasn't been understood and modeled for properly when you're thinking about those risks. So with each new cat loss, the industry learns a little bit more, the models get a little bit better, that works its way into pricing. But generally speaking, we've been falling behind and trying to play catch up here. Well, let's just take a recent example here, the California fires as a sort of a real life example. The fire losses in 2017, 2018, and so far in 2020 are well above sort of the historic norms that we would think about in terms of wildfire losses in any given year. And increasingly it appears, at least as an outsider, that the warm season and the high wind season are overlapping more often, which is creating a greater fire season, more fires. The more fires you have, the more chance you have for loss. And we've seen really over the last few years that's really come through, and the industry has pulled back its capacity in that market, whether it's on the primary side or on the reinsurance side. Now, I'd add that it doesn't help that in California in particular that the rules can and often do change after the fact, which is a consideration that insurers are faced with as well, that adds to the uncertainty in that market. But that's just one example. As this chart shows, there's a number of other learnings that we've seen over the last decade, whether it's flooding from Hurricane Harvey back in 2017 in Texas, or the fact that you could have a large storm like Superstorm Sandy impact the Northeast in 2012. So lots of learnings, but it always seems like the industry is playing catch up there for what the true underlying exposure is on the property side. Next slide, please. Secondly, by our analysis anyway, the industry overall loss reserve position wasn't in great shape even before COVID. And so if we just ignore the personal lines for a minute, which makes up about 25% of overall industry reserves, and we'd argue that both personal auto and homeowners look to be about adequate, and instead focus on the commercial line side, which is really where the action is. If you ignore, again, workers' comp for a second, which has been, we like to say it's the gift that keeps on giving for the industry and many of the insurers that are larger workers' comp writers. Each of the other major commercial casualty lines look to be deficient to us. So if you look at the trends within the other liability lines, so that's general liability and management professional liability, so things like D&O, E&O, EPLI, those trends were particularly concerning to us when we reviewed the Schedule Ps. Each of those lines appeared to be deficient overall and appeared to be in a weaker position than they were a year ago. So this is based on year-end 19 data. We get this information once a year in March. I'd also add that commercial auto, it's been a problem line for years for the industry, really looked no better this year despite another year of double-digit rate increases. So putting it all together, as of year-end 19, we estimate that the overall industry reserve position is now slightly deficient. And so, what that means from an earnings and return perspective is we don't think that insurers will have the same benefit of reserve releases moving forward. So that's not, those releases aren't there to help their reported results. And in fact, in some cases, we'll see insurers and reinsurers that have to add to reserves, which is a reduction in their overall earnings and returns. So something that we're certainly keeping an eye on going forward, but a weakness for the overall industry. Next slide, please. Third, and I'd say related to our view on the overall loss reserve adequacy, is increasingly there's concerns around social inflation or an elevated level of loss cost trends, depending on how you want to define it. COVID-19, which we'll talk about in just a minute, has likely served as a temporary relief for the industry, with courts closed and plaintiffs' attorneys looking to settle claims more quickly just to get some money in the door. But it seems that we're moving past that sort of initial benefit stage, and insurers are talking a lot more about the pressure from social inflation. If we look back in the first quarter earnings season, basically nobody talked about social inflation. Last quarter, it was talked about a lot more again. We're very quickly approaching third quarter earnings. I expect it's going to be a major topic again this quarter for the publicly traded companies. And we think that's going to be an issue going forward. And what do we mean by rising social inflation? In practice, really, it's the cost associated with litigation trends. And you can see on this slide, there's a few examples of what we mean. So that could be increases in plaintiff activity, the fact that the plaintiff's bar is pretty well funded, and one of the areas that we've been watching more closely over the last really couple of years now is litigation funding has really picked up. Outside investors supporting litigation funds that support lawsuits against, whether it be insurance companies or others. It's a emerging asset class that we're keeping a close eye on. You look at the jury makeup and millennials feeling more social responsibility. We've seen an increase in the number of what we call nuclear verdicts, where the settlement value is just significantly higher than what you might otherwise think. And then also attorneys leveraging technology and sharing data better than they ever have before. So all those contribute. Next slide, please. So one of the areas that's pointed to a lot as it relates to social inflation is the number of securities class actions being filed. As the data here, which we're using NERA Economic Consulting, what this shows is that securities class actions have been elevated for several years now. In part, that's driven by an uptick in the merger litigation lawsuits. You can see that that's the green bars there. But even beyond that, just sort of the normal level of securities class action is running well above the levels that we saw in the sort of the 2010 to 2015 range, and it's trending much more in line with the early 2000s. Now, this is probably most directly affecting the management liability market, D&O in particular, and that's certainly been cited as a contributing factor for the significant changes we're seeing in that market and the underwriting appetite that we've seen from a number of insurers in terms of pulling back and driving price. But arguably it's broader than just that. And we use securities class actions as a reference point, but I'd say we're broadly seeing an increase in attorney involvement across the loss spectrum, and that's leading to, as I mentioned in the last slide, higher settlements, higher loss cost trends, so higher loss adjustment expenses, and all those things have a direct impact on insurers' reported results and the rates that they need to charge to generate adequate returns. Next slide, please. And that finally brings us to COVID, which is an area that we've written and talked a lot about over the last 6 months or so. I'll just leave you with a few observations on the trend as we see them. I'm sure it's going to be a topic that gets talked about more broadly on the panel discussion as well. But based on our latest estimate, we think that overall insured losses are likely to be somewhere in the range of $40 to $80 billion. So admittedly, a large range. I'd say there's a lot we still don't know, but at that level, that would be one of, if not the largest catastrophe losses in the last 30 years. Now, we think about half of that loss is going to be retained by primary insurers, and about half is probably going to make its way into the reinsurance market. So important consideration there. We'd also suggest that we're still in the early innings in the loss recognition process. To date, we've recognized somewhere in the neighborhood of $20 billion of insured and reinsured losses. Now, that being said, the reserving methodologies and the results appear inconsistent to date across companies. So I'm not sure we'll ever see a complete accounting of the losses, but I guess our point there is that there's still a long way to go in terms of recognition of loss. And honestly, to date, what we've seen is really the easy stuff. It's things like event cancellation, credit, non-damage BI, the losses where you know the event has happened. So event cancellation being a great example. Wimbledon was canceled, the Masters was canceled, the Olympics was postponed. Those sorts of things, there's a loss. But what we really haven't seen yet is the indirect exposures, and so that's the US BI, the liability exposure, surety, even some of these things that we're describing on the left chart here as middle innings. The non-US BI exposure. There's whether it's the FCA lawsuits or some of the trends in Europe, we're getting farther along, but there's still a number of unknowns yet to be recognized. And so clearly keeping an eye on those things, but in our view, still a lot of loss still to come from an industry perspective as it relates to COVID. And so with that, I'll wrap it up and pass it back to Chris so we can get started on the panel discussion.
Thank you, Kyle. You're obviously experienced because you hit your timing exactly. So thank you for that. So we're going to move over into our panelist discussion at this point in time. And we all know Kyle at this stage of the game, but I'm also pleased to introduce the following panelists joining us today. We have Michael Rouse, who I'm sure many on the phone know, and he is our U.S. property practice leader. We have Dan Aronson, who is our U.S. casualty practice leader. We have Michelle Sartain, who leads the FinPro practice in U.S. and Canada. Pat Donnelly, who's the specialty leader in U.S. Canada. And we have Nathan Richmond, who's the global placement leader in Canada. So our hope today is to have sort of a dialogue, a discussion, a conversation around the marketplace, weaving in some of the themes that Kyle has put forth. Again, with the hope of driving just a better understanding of some of the movements in the marketplace today. And I also know, just so we're all aware, Martin South, I think, stands by too to join in if and as appropriate. So thank you for that, Martin. Hey guys, why don't we lead off? Maybe I will. Maybe I'll send a question to Nathan, sort of an overview question. I think Nathan, Kyle has provided, a lot to think about, a lot to sort of process relative to impact in, as it comes down into the retail insurance marketplace. Any thoughts from your perspective on what we're seeing in the market and how that ties back to some of the commentary made by Kyle?
Yeah, sure. Thanks, Chris. And I guess 20 years of built up pressure at decreasing embedded yields is something to deal with, right, as an industry. So, I mean, I think the challenges our clients are finding it difficult, right, in this marketplace. I think we're all looking to lead our organizations in a complex world at the moment with COVID and the impacts of that, but also the emerging risk that's coming through the industry that our clients are looking to transfer into the insurance markets, which are facing the same challenges as them. And then in addition, as Kyle's laid out, this underlying fundamental profitability challenge. And so, Kyle also referenced that there's a simple formula within the industry around how to make money for insurance companies. I think sometimes, the impact of that is we also see some simplistic tools being used by the insurance industry that clients are having to deal with. And so many of our clients will have had the challenges of increasing premiums, reduced policy limits being available, tightening of capacity or capital that their insurance companies are willing to offer, and tightening terms and conditions of coverage as well coming in. So all of those impacts, I guess, from a client's perspective, is significant financial impact to the client. It's challenges managing and working with their internal stakeholders. And so no doubt we're seeing this rebalancing of the marketplace, which is challenging for all parties, as history's always shown us.
Yeah, good point. Thank you for that. I think, Dan, from your perspective, maybe specific to the casualty practice, excess casualty in particular, wherever else you think, are there some more specifics in your marketplace that are playing itself out, balanced against Kyle's comments?
Yeah, listen, even before COVID, work comp was still trading very favorably, and we were starting to hear messaging around work comp is starting to worsen. I think they were benefiting from taking some reserve redundancies out, but it was still offsetting the liability marketplace, and that liability marketplace was just getting increasingly difficult. I think it really started, I would say, probably April 1st of 2018 for many clients. And particularly in excess, it started feeling as if the carriers weren't really changing their mindset depending on the type of risk. It almost felt as if every risk was being viewed as being able to have a large loss. And this was really driven by large loss settlements that were coming in all different industries, many industries that were previously targeted for favorable premium from the carrier perspective. Now all of a sudden was driving loss experience, and the carriers started looking at everything in terms of what's the payback period. If I write this for $100,000 and I'm putting up $25 million of limit and I have that large loss, it's going to take that many years to recoup that. And that was really driven throughout. And Chris, that manifested itself in the attachment points were starting to go up for many risks. Coverages were being pulled back for many risks. Shorter lead limits was a big piece. And a lot of carriers were reducing the amount of limit that they would put overall on a tower. So that's really how we were seeing it in casualty.
Yeah, no, thanks. A lot there. Hey, Mike, maybe, before we sort of move on to some of the other questions, you've been in a difficult market for some period of time now. Any thoughts from your perspective on the current state of affairs?
Yeah, thanks, Chris. To your point, kind of coming into this year, we were facing probably 9 straight quarters of positive rate environment on the property market. Without a doubt, as we've gotten into 2020 and the events of certainly with COVID, there's been a bit of an acceleration of, I'll say, the deterioration of the property market. So the biggest thing that we're seeing today is being able to differentiate risks, starting to potentially see a little bit of a bifurcated market, but probably more into 2021. But, when I think about property, Chris, it really comes down to, one, the amount of loss activity that's occurring and has occurred over the last 3 years. Kyle talked a little bit about the potential size of the losses associated with COVID. But if I think about losses excluding COVID, kind of through 3 quarters, Guy Carpenter is reporting somewhere in the neighborhood of about $55 billion. And that's all driven by wildfires, flooding, severe convective storm, and obviously a kind of record hurricane year that we're still experiencing. So there's a lot of headwinds in the property market. And so there's that pursuit for profitability that I think each individual property underwriter is out there seeking. And whether we can get there, whether we can drive enough supply and demand, and making sure that we're differentiating risks, which is critical, will ultimately kind of drive to how much longer we stay in this current cycle.
Okay. Pat, specialties markets, inclusive of energy, marine, aviation, other markets. Any thoughts from your perspective? I mean, they sort of cross over obviously into property and casualty, but as sort of particular focus on the industries and sort of the risks there. Any thoughts from your perspective? And then we'll move on maybe to some COVID questions.
Yeah, sure. Yeah, you're right, Chris. I mean, when you look at the specialty market, to a large degree, you're taking some of the comments that have been made about the broader P&C market and some of what Dan and Mike described in the property casualty marketplace, and you've got those issues, but exacerbated by a really complex environment for specialty property casualty risk. And then in others of the specialty areas, you've got just these really, I guess, interesting dynamics around how we entered this period and the impact of COVID. I know we'll talk about it in a second, but how we've entered that market and the impact of just a significant disruption in business operations in some of those businesses, what it does to the exposure base in, say, an industry like aviation or an industry like marine from a hull and liability perspective, and then the pressure that puts on the marketplace in terms of how they think about pricing that risk in this environment, or as we think about coming out of the environment. How does it really change the exposure that they're seeing currently, and how do they price for that very significant reduction in exposure when they're thinking about rate? So, the specialty business, we sort of define it by 7 macro businesses here at Marsh. But when you dig into it, it's about 22, 23 subsectors that you have to dig into and dealing with different issues.
Great, thank you. Hey, Nathan, quick question for you. We've sort of covered this as a group, but there's a question from a client asking any major differences between US and Canada. And while the rate differences might be slightly variable, I think the general answer is Mike's comments and Dan's and Pat's and Michelle's sort of relate exactly to the Canadian marketplace. Is that something you could affirm or comment on?
Yeah, for sure. I mean, look, fundamentally, the marketplaces are similar, although, there's some nuances within Canada. I think there's some nuances of the long-term soft market that the Canadian customers have and the insurance industry has created. And so there's a fairly violent swing and change. And I think, the reported turn in market rates and increase in rates pressure has come in a bit quicker in Canada at times for certain product lines. I think also from a macro perspective around, say, property, the marketplace is now starting to contract around some of the geography sort of provinces within Canada around earthquake exposure, for example, which has always been there and been acknowledged. But now that increased scrutiny that's coming onto the portfolios is driving more questions around, well, what is my aggregation of risk within Alberta, within British Columbia, as a result of natural disasters, etc. So, at high level, similar. There's certainly some nuances in Canada.
Okay, thank you. Why don't we pivot, folks, to a quick discussion on the impact of COVID-19 on the marketplace. I think as an industry, frankly, to some degree of credit, it's proven to be somewhat resilient as far as being ready and available in a moment's notice in late March to sort of keep the process of quoting business and binding business going. But certainly it's having an impact on rates and terms and conditions. I think, Mike, you might suggest that it's just one of many sort of challenges you and your team face on behalf of our clients. But given sort of, the attention to non-physical damage business interruption, perhaps you could kick off a few comments from a property perspective on the impact of COVID-19.
Yeah, so Chris, I think your point about kind of continuing to trade and service clients, we've hit the mark seamlessly, and I think from a underwriting perspective, it's been the same, challenged around some engineering, boots on the ground, and inspections, but working with carriers to do some of that stuff virtually or in other ways. In general, the market going into, I'd say, March, or when we think about it, January and February, as I mentioned before, we had a consistent kind of tough market following Harvey, Irma, Maria that was slowly but surely gaining some momentum. Our portfolio was low single digits in the early days of 2018, or I should say quarters of 2018, and then towards the tail end of 19 and into 20, we're now into kind of high double digits, hovering around kind of the average rate increase on our portfolio being close to 20%. So it was largely, the market was largely really a pricing issue within the property market. Some aspects of terms and conditions, no doubt, but following the events of, and I'll say March, or kind of the initial, I kind of use 4/1 as really the kind of call it shutdown here in the States. We saw the market turn real quick. One, further deterioration around just pure pricing. Two, terms and conditions. So a lot of the, I'll say time element extensions or non-physical damage BI, think about, attraction properties, ingress, egress, civil military authority, and so on, being coverages that carriers are really scrutinizing. What was the need for the coverage? What was the potential exposure? Were they comfortable providing it or not? And then as we've kind of gotten a little bit away from 4/1, we've seen the market just continue to deteriorate and question the usage of manuscript forms versus company forms. So definitely a big scrutiny of terms and conditions, which obviously when compounded with rate, it's a bit of a double whammy. And then, you kind of throw on to, unfortunately, we're in the soup with a whole bunch of different things contributing to the property market when we think about this civil commotion, strikes, riots, activity that's happened in the U.S. as well as globally, some of the hurricane activity. And so it's really been, depending on carrier, I'd say it's been more of a pursuit towards profitability from a property carrier standpoint. Up until, I'd say, July, we saw a market that was very much a take it or leave it type of market. Whether that was on terms and conditions and or pricing, we saw a supply from a capacity standpoint, essentially for all risks, kind of start to reduce from some of the historical levels. But over the last, certainly at 10/1, still a tough market, but starting to see a little bit of signs of a bifurcated market. And so I'm going to be a glass half full kind of guy on this statement. But, depending on how we kind of get through the balance of the year, I do see some signs that for good risks and clients who are differentiating themselves, not suffering from significant attritional losses or severity losses, there is a little bit of a flight to quality, some new capacity that's kind of coming to the table, whether that's some purely new capacity in the form of MGAs or through London, or just existing carriers trying to write some new business. It's been something that we haven't seen in historical quarters. So I'm a little bit more bullish towards, heading towards a bifurcated market with the better risks, perhaps seeing a little bit more capacity, driving a little bit more demand in a competitive environment. Unfortunately, though, there's still that segment of the market, certain industry classes, chemical, forest products, mining, metals, I could name a bunch, where there's been significant attritional losses or per risk type losses. And there's just still a reduction of capacity in that part of the marketplace. So we're fighting to differentiate our clients. We're fighting to drive new capacity solutions, and ultimately bring new capital to the marketplace to drive a little bit more of a competitive environment. But we're still in the woods, but there's a couple of positive signs that I see on the horizon that could benefit our clients and change the market a bit.
Thanks, Mike. Super answer. Maybe Michelle, I could toss it over to you. Financial lines. Mm-hmm. Perhaps not as directly impacted by COVID-19 at the outset, i.e. with exclusions and whatnot, but certainly have an impact on the economy. Any thoughts from your perspective on COVID-19?
Yeah, thanks, Chris. I mean, that kind of sums it up, right? Well, we've seen about 21 securities claims that are directly related to COVID. The big issue that's really kind of challenging the market right now is what's happening with the economy. Underwriters are concerned when they look at kind of their books and their portfolios. Over the last number of years, bankruptcies have represented a low single-digit percentage of the numbers of securities claims that they've seen. But when you look back to the tech bubble burst and you look back to the financial crisis, bankruptcies represented upwards of 20% of the numbers of claims that they had. And that was on a much smaller base, as you'll recall from Kyle's slide. So, and of course, those are just securities claims. They don't take into consideration the private company D&O claims or creditors claims that don't fall into that class. And this is with Bookings Institute recently came out and showed that since 2008, the amount of commercial debt is up by about 52%, upwards of $15.5 trillion. So really underwriters' concerns is just around, is there an avalanche coming related to bankruptcy type claims, and what's that going to mean against the losses that they not only already have on their books, but that they would expect to be paying in coming years.
Great, thank you. Hey, Dan, maybe a specific question for you from one of the clients. Basically asking, hey, if there's reduced cars on the road, reduced driving, people are staying home. I think they're seeing an impact on personal lines. Any view from you as to how that's having an impact in the commercial marketplace?
Yeah, I want to step back. When COVID first happened, right, I remember meeting with all the carriers on the phone every morning, and a couple of them, the senior folks would always say, this is our time to be commercial, right? This is when insureds need us most. And I bet the feeling for many clients is, wow, it doesn't feel very commercial, right? My exposures are down. I have to fund payroll when I don't have revenue coming in, and yet you're asking me to pay for premium where I don't have the same exposure out there. Personal lines is I think easier to give premium back because of the loss ratios, and individually those clients aren't having the size losses that our carrier partners are in the commercial space. So it felt very unfair. And we also had the situation, Chris, where it wasn't just autos on the road. We had people completely shut down. We had people that were shut down for periods or in perpetuity until who knows when, and where they had changed their operations completely. And I think the insurance companies were all sitting there saying, hey, you have to recognize that I don't know what's happening with COVID. I don't know how that's going to play out in liability. I don't know how it's going to play out in workers' comp. I still have tail losses that I'm trying to pay for. And the carriers were pushing back on, we can't do the same thing in personal lines or in commercial space that we did in personal lines. So, I'm not here to defend the carriers, but I think there were so many nuances, and the industry was hit so quickly with so much, and there was so much at stake. And companies still had various exposures out there, whereas someone who just keeps their car parked right in their garage, that shuts down that exposure. So I think it was a very tough switch to really make. Not to say that there weren't individual instances where carriers stepped up, not to say that we're not pushing for clients to get what I think is a better midterm program than what they found based on what they thought. And not to say that there shouldn't be something reflected in the renewal, Chris, to offset what they kind of, in my mind, overpaid for in the current year.
Yeah. Okay, great. Maybe we move on, conscious of the time, so we stay to the allotted hour. Michelle, we talked, and then we'll open it up for the various other practices, but key risk trends moving forward. Mm-hmm. Beyond the pandemic, securities claims, obviously 400 plus or so per year. Any thoughts from your perspective? Cyber, ransomware? Yeah. Sorry, I'm probably answering the question.
Right, all of the above. I'll switch seats with you, Chris.
I'll leave it with you.
Yeah, I mean, for financial lines, and I'll start with D&O. The issues are the same now as they've always been, right? Obviously, it'll be about the economy, as I discussed. It'll be about changes in law, like we saw underneath the PSLRA and the Dodd-Frank Act, and it'll be around court decisions, right? Like when you look at the Scion decision, or you look at Quebec's defense outside the limits, which had a direct and dramatic impact on the market. The one thing I will add to that, though, that we've seen in recent years is something that we call event-driven litigation. And cyber is a perfect example of that. So in 2009, really the first case that we saw was the D&O claim for Heartland Payments that came out of their cyber breach. And between 2009 and 2017, there were only about 17 claims that arguably were event-driven. But since 2017, we've seen about 75 claims that have been brought against directors and officers out of things like cyber breaches, Me Too, COVID, wildfires, and things like that. And many of those claims are not only direct securities claims, but they're also derivative claims. So opening up the A-side D&O policies to payment of loss that hadn't historically been priced for. So I think that those are going to be the key contributors. And then one other thing that we're watching, and I hope they aren't on the line, but if litigation funding comes to the US like it has in Australia and the UK, I think it will have a dramatic impact on the D&O market. And then, as you mentioned, ransomware, huge issue in the cyber space. The ransomware payments or demands are going up. The frequency is going up. The outages are being prolonged. So definitely a spot that we're watching very diligently right now.
Okay, outstanding. Thank you. Before we come back to the other panelists, the questions come up, and I want to sort of throw it to Kyle. And it's an interesting question, given the historical sort of low return rate. why does anyone invest in the insurance industry? So perhaps you're probably best equipped to answer that question.
I'll give it a shot, and I'd start by saying I hope people continue to invest in insurance, because without it, our recommendations don't mean a whole lot. But in all seriousness, when we look at all that data that we were showing was the overall U.S. industry. So roughly half of the industry is non-public companies, so mutuals, reciprocals, and the like. So mutuals they have a different return perspective, right? They're not looking to make an attractive ROE per se. They're looking to grow surplus and make sure they have surplus there to support their policyholders who also own the company. So if you ignore the 50% of the industry that's mutuals for a second and just focus on the public companies, those companies tend to do better than the overall industry. But even beyond that, the spread between the better performing companies and the worst performing companies is quite wide in property casualty. We used to say it was the widest among any financial services industry. I think that's still true, but I don't know that for an absolute fact. But you look at companies like Progressive, and obviously personal line side, but there's a company that generates ROEs in the mid to high teens, sometimes in the 20% range. So there are those companies that are very well run and that outperform, that actually generate attractive returns for investors. And then the other thing I'd add in there is there's always the short side. So you don't just have to be long the stocks. We have plenty of investors who go short on the stocks and expect them to go down. So there's a lot of different ways you can play it as an investor in property casualty.
Understood. Thank you. Why don't we move to given the time, we'll move to our final question. And maybe I could ask Pat to sort of kick it off. But, as you think about our clients on the phone, as they begin to think about their pending renewals later in the year, fourth quarter into 2021, any specific thoughts, advice, counsel, you would begin to organize on behalf of these clients relative to how to best prepare, with our goal of sort of achieving optimal outcomes. And then maybe we'll just go around the horn with any additional thoughts. Appreciate any thoughts, Pat.
Yeah, sure. Thanks, Chris. We sent this out as a polling question as part of the registration, and about half the respondents, about 500 of the 1,000 respondents, talked about starting the process early. About 30% talked about using data more effectively, differentiating their risk based on data. And the next was involving senior leadership. Again, along the theme of trying to differentiate risk and on the theme of partnership with insurance companies. And about 5% of the respondents answered other. And I sort of have to side with the other, and it's really in two camps. One was a comment that it's really all of the above, that you've got to do all of those things. But a few respondents then also talked about consideration of alternatives. And Chris, I think if the question is, how do you achieve a better outcome? I think the answer's got to lie there. If we start early, if we involve senior leadership, if we're able to differentiate based on data or risk profiles or whatever the case may be, hopefully we've done our job in helping our clients properly forecast, set expectations as to what will happen, and even with things like this, being able to tell them why. Why is this the experience I'm left with during this renewal? But even still, I think to show diligence, to ensure you're not caught flat-footed if you're disappointed or expectations aren't met by the markets, or to that question of achieving a better outcome, I think you've got to be thinking about considering alternatives and possibly making some changes. And that could either be in program structure, it could be your insurers, the appropriateness of your insurers, the adequacy of the limit you buy, appropriateness of retention. Is the structure I buy the most optimal and efficient given the pricing being offered? If that decision was made in a different renewal cycle, it needs to be revisited. It could be a change to the way you market your program. We've had a lot of success with some insureds, particularly with global exposures, who are getting better results by really exploring the full global marketplace. right now who've bought a little more locally historically, and looking at some other sources of capacity. And then I know a question was asked about it, but I think the other thing is different risk financing structures and alternatives. You've got to do the diligence and explore them. For years, we explored them, and risk financing, risk transfer capacity was so cheap and plentiful and effective. And we didn't have the data to explore some of those other solutions. And I think that now, whether it's offshore wind or other solutions that we've had some success with clients, and particularly some of our energy and construction clients. I think that's the other area is exploring even different vehicles to finance risk.
Okay, super. Sorry. We've got a little reverb, so apologies there. Hey, Dan, how about you? I know you've given tremendous thought to alternatives, and you've got experience in sort of thinking through complex solutions. Any thoughts from the casualty side as to preparing for the next 6 months or so of renewals?
Yeah, listen, I put into two buckets. There's the exposures, and then how do you deal with it? On the exposure side, I think we really, and some of this is kind of more of an analytic approach. How do we really break down the exposures to identify how this risk is differentiated from other risks, or how it differentiates from itself in the past, right? So how many vehicles are no longer on the road, or how many miles are they going? What is the distance that they're going? How many people are actually working from home to, reducing the work comp exposure from a concentration standpoint. So really breaking it down, how the risk has changed quantitatively from a dollar exposure amount to qualitatively, how the ops have changed, and really getting that story across. The second thing is, I think in casualty, and Pat touched upon alternative risks, integrated risk and different products such as that are great, but we could even do the same within casualty if you tie the primary with the umbrella and the international as an example. You're allowing the carrier to now have additional dollars to leverage. And the idea is they're not going to get hit in all different areas in 1 year. So maybe what you can do is get additional capacity from that in the excess tower, as well as drive a better result on the multiple lines within the practice.
Super. We're tight for time, so maybe Mike, I could throw it to you for 60 seconds of thoughts.
Thanks, Chris. I think Pat and Dan, some of the things they said certainly correlate to property. It's starting early, differentiating risk, good, a risk profile, a good articulation of what you're doing to help mitigate risk. I think for in certain industries where there is a lack of capital or capacity, utilizing a captive if available to take a quota share retention, in some instances, a higher aggregate deductible and aggregate retention to eliminate some of the attritional losses, and then complementing an all-risk structure with maybe a smaller parametric buy to cover some of the non-physical loss or damage, or some of the things that are currently being excluded from company forms. So, it's really just taking a holistic approach and thinking about all possible tools that are out there to really drive competition and put the leverage back in our clients' hands versus in the markets.
Outstanding, Mike. Thank you for that. Well, with that, we're at just about at the top of the hour. So I would like to thank the panel and Martin for your participation today. I'd like to thank the audience. Hopefully you found the last 60 minutes to be informative. We will have a replay of today's program available in the next 48 hours. And we will be incorporating the slides. I know there's a number of questions coming in that folks, Kyle, everyone found your slides to be super informative. So thank you for that. Frankly, as Pat and Dan and Mike and Michelle and Nathan were articulating, we're here to help. We're here to help you prepare for your renewals. We're here to advocate on your behalf. We're here to broke hard on your behalf. So we look forward to continuing to serve you as best we can. You can contact any one of us. Our details will be available. You can contact your Marsh representative, and you can email, if you're interested, you can email to the following email box, which is questions@marsh.com. That's super original. So questions@marsh.com, and we will do our best to get an answer. The next Global Insurance Market Index will be published in just about 30 days as we aggregate the global data. That will be available on marsh.com. And we will also be issuing a paper which will be incorporating many of the ideas that you've heard today on how best to manage your upcoming renewals. And that will be made available to all participants on this call. So with that, I'd like to say thank you and have a great day. Thanks all.